Hi everyone. Sorry, I know we promised that this was going to be an in-person, but just due to some of the weather, it kind of, I guess, not meant to be. So October will be the month. But like Dr. Dillon mentioned, I think this, start talking a little bit, this week about kind of the strategy creation. I think that's something that's come up from a lot of you guys, and especially as you look towards, your own careers as well as your own trading. I think working on some of the data-driven risk management seems to be like a topic of interest. So with that being said, let me see if I can share my screen, a couple of slides, and then Kranthi will come join, and then we can also finish up from there. So
you're sharing, it looks good.
Okay, perfect. Okay, so so week two, I think I wanted to start off with a little bit of market color, especially, I think we had spoken to some of the people that joined early last week about Jackson Hole and how that was impacting the dollar, and that, what the impacts of that were going to be on equities and rates, which I think in FX obviously was a big point that time. But I thought it'd be helpful maybe we just sort of talk about what's been going on, in my world a bit. So like I mentioned, we cover commodities and FX from sort of the systematic trading side, and something that's been very in vogue right now is sort of natural gas, which generally is not something you hear about in the news. Maybe you'll catch it in a Billions episode, once in a while. But so this year has been, gas has actually been kind of like a bear market outside of winter for almost over a decade. And this year has seen quite a resurgence, especially in the last month. And so, I kind of just plotted here. This is from Bloomberg, on the bottom screen, the October contract. And so, we'll talk about futures and how, everything has an active contract. But just the pure front contract for American gas, European and financial gas are all, on record highs, with European and British natural gas up, over 250%. And so this is actually kind of a relevant point, because a lot of returns, especially in sort of the commodity oriented sort of systematic risk premia strategies, tend to be generally short gas in some way, and that's been a big contributor to performance. But obviously, so this move has caused quite a bit of pain, and I think right now we were up another 30 cents today, which is another 7%. So just something to kind of be aware of. I think part of the point of the discussions were how do we start to look at things outside of equities, and where are some of the markets that may be interesting for either personal trading or your professional careers, past kind of like, again, that boring stock side. And so, one of the things that I've really enjoyed, I think, in the macro space, which is, sometimes synonymous with FIC, is that, you do see these kinds of impacts. These price, shocks here have real world implications. The issues that are going on in Europe and the UK, that all really high gas prices impact, heat generation and how that gets passed on to the consumer. And, you start to see things that, like what happened in Texas with ERCOT, right, and power, and people that not really paying attention to their sort of power plans and their structure of like what the variability is. Some of them walked away with, hopefully none of you guys, but I know I have friends that walked away with 5-figure power bills for 1 month. So when you think about things like commodities and rates and even the dollar, to some extent, it's the G10 especially is a little bit of a doldrum sometimes, but that directly impacts sort of the purchasing power, right, of people in individual countries. So the macro space, I think, is just really interesting, and it has a lot more kind of, I think, real world applications outside of just something that grinds higher in someone's 401k. So just wanted to highlight that, what's kind of been going on, something that we've been looking at. This was as of yesterday, so you can see big move in gas, but just trying to a little market color there. So then I just want to kind of touch base. So we had, I sent this around, the responses from Michael and John, which is great, about some of the questions that you guys had sent. And then just to kind of review, I know we got cut a little bit last week on time, but if there's any questions, want to give everyone sort of like a brief opportunity to to ask, past what was sent in, if there's anything, any follow-ups anyone had any interest in from last week about kind of like the opportunity set, in finance and things to be, either working on or looking for. If anyone has any questions, happy to answer that, or else I can move on.
Max, can we make this presentation available to the students so they can read these responses?
Yeah, sure. Now, of course, yeah, by all means, please. And then, I think we emailed them out as well. Especially as you guys go through the semester, if there's any other questions, please feel free to reach out. I can pass them on, answer them myself, pass them on to John and Michael. But I know that the fall is a busy time, especially as people start staffing for summer programs and stuff. So I will say, just I think as a quick note on the first question, so someone had asked about, what exactly is market intuition? And I would make the disclaimer that I think, even just in the short tenure that I've been doing this, I've seen that the interview process has become more and more, I think, akin to the consulting in a bit. And so where, you're not going to have some very old school MD that's looking to, badger you about the price of something. It's more, I think, that people are starting to look to understand like how candidates work through a process, how do they rationalize through a problem set or a given set of circumstances. And so I think that's something to really focus on and to, not get tripped up on, what is, something very sort of micro specific to whatever role or market. And because honestly, the reality is if you get someone that is that kind of interviewer, they likely are not going to be a great person to work for and to start your career with. So that would be the only disclaimer on the market intuition. And it's really just more about like, how do you approach a problem? So just to touch base on that. But okay, so why don't we, moving ahead. So at the end of the day, everyone here was kind of interested in like what exactly is systematic trading, and I can give a little bit of a insight, hopefully, to that from the professional side. And so really what everyone does is they're just creating a function, and that function really at the end of the day only has three outputs, which are some form of market action. And in reality, you can make it even simpler and say there's only two functions or two outputs where you buy and sell. And there are, hundreds of thousands of people that work on this and sort of work on this process across all asset classes, across all sort of derivative domains and timing domains. And at the end of the day, there is kind of a large overlap in what the information set is, right? I mean, you can pay now, and this was kind of in one of the articles, I think, on the alt data. I mean, there's more and more sort of sources of information, and I think, the value of that is still TBD a bit. How valuable is the satellite imagery of, let's say metal stores in China? That's still to be seen, and whether that can actually lead to some sort of actionable insight. So, for the majority portion, especially as it relates to equities, I would say there is kind of like a commonality to what people are looking at. So really, it's how the skill comes in is like, how do you process that, and how can you make something that generalizes without overfitting, right? And that's the problem that people see everywhere. And what I think is something that is lost a bit in some of the the common media representation of these things is that everyone is thinking, okay, how do I make the best line from bottom left to upper right when it comes to building a strategy? And I think what gets sort of lost a bit is that you sort of have to come into it with an acknowledgement that, one, you're going to lose money. I think that's something that we'll talk about during the buy side week. But you're going to lose money, and no matter how good your process or how well you clean the data or implement the model, there's always going to be some error which you really are not going to be able to correct. And if you have an errorless model, then you shouldn't even be in school. So the real skill that I think the secondary portion of the skill set then is how do you mitigate that? And this is where diversification comes into play in the systematic world. When you hear about systematic traders, it's like myself, and everyone that's on my team, here and in London, and the people who work within in Asia. I mean, no one is really a domain expert, right? And so you think about there are people that build their careers in both banks and the buy side, and they trade kind of like one asset, right? And those people effectively know the ins and the outs of, let's say, the oil market, or they know the ins and the outs of let's say the dollar, and that's all they do. and you can make extremely robust career like that. It's just a different sort of it's just a different objective function. Whereas when you think about systematic trading, the idea is that you're sort of creating a portfolio of processes that generalize in some way. um, and so everyone to some extent has a little bit of background knowledge, and there will be things that people pick up, just they happen to gravitate more as the career progresses. But in general, they're looking to apply their process to a wide array of factors. And so, one of the things I want to touch on here is that the diversification, I think, gets a lot of play in terms of, how do you diversify across asset classes and the components that are in the portfolio. Um, but so the two of the things that we focus a lot on in the trading side is that there's other ways to diversify, both from a timing and a signal side. And I think the timing standpoint is something that's really interesting, because a lot of what people have in their models is noise, right? And yes, there are ways to sort of hopefully reduce that and sort of promote the signal. But one of the easiest ways to sort of manage that is to have different types of strategies that, even if it's on the same underlier, that rebalance or sort of evaluate themselves on a sort of on a different periodicity. So, personally, even what we do, for the risk that we run on the desk, we try to make sure that we have things that trade intraday, that sort of evaluate daily, weekly, monthly. And like I said, even there are some things, especially at the less sophisticated investors, that actually, rebalance on a quarterly basis. So, that's one side. And then I think the other side, past the underliers, is kind of the signal idea. And I think this is more of a mature sort of portfolio management idea. But something that we get to now is that you tend to have a core set of strategies and a core set of focuses within your own trading. And the idea then is, once you have that, is how do you add orthogonal risk, right? Because you don't really need the same exposure, and you don't really want necessarily netted exposure. So then is where you get into some of the, maybe like the less broad, but still, maybe a little more focused of a risk type. And so here, in the commodities markets, one of the things that's in focus is kind of like the relative value between different physical assets that are delivered in different points in the world. And so that's thinking about like the price of copper in London, which is a primary sort of locale for base metals, and versus the price in the US. So that kind of strategy, it's not going to be probably the first thing that something would look at, but that's how that kind of risk is something that, scales. It has generally, very low correlation to something more broad-based. And that can sort of help you add and be a more robust trader, and or portfolio manager. So, across the diversification is kind of like the first thing, if you think about like, this matrix of where do you diversify, and then how do you take the actual risk, and how do you take the actual strategy types. And so I think that, there are three main veins that we kind of focus on. And then, so we kind of describe them, I guess, at either end. You have the observational and sort of advanced predictive, which is how I've diagrammed it. At the observational side, this is kind of what we would describe in terms of like the systematic risk taking, where it's more of like a data observation and visualization process, where you're able to consume and sort of display to some extent patterns that you don't necessarily have a concrete reason or rationale why it occurs. And some people will say, if you don't understand it, you shouldn't do it. But I think there's a famous quote from Jim Simons, who founded Renaissance, who I actually met, and he was very pro this kind of risk, because it's not something that there's a lot of crowding in. It could be something that you are singularly picking up, or a small amount of people are picking up. And I think you have to be a bit hands-on and making sure you understand when it sort of stops working. But these are the kind of things that small risk allocations you shouldn't necessarily pass on. And so this is as a quick example that we listed here is that sugar futures could tend to revert, let's say, for the 30-minute bar before the true New York morning. So sugar tends to open overnight, somewhere I think like in 3 or 4 a.m. Eastern time, and large moves may not be sustained because there's no liquidity. So you could have a strategy where you pick, and sort of mine what percent move triggers an alert, and what kind of liquidity or volume profile you might need before you take the opposite position. But things like that, right? I mean, that's something, it's a pure data exercise, not necessarily a real rationale behind it, but it's something that maybe you feel you could allocate some, as part of your risk budget to. Then, conversely, you have the other far side, which is, I think, something that's coming in vogue, especially in a lot of the machine learning programs, and you get all these data science backgrounds, and you have, I think, a very strong uptick in processing and computing power over the last, decade and a half. And so this idea of like advanced prediction is where people are pretty much feeding all the data they have, and everything that they can sort of acquire into some big algorithm, and the idea is it spits out market actions for across the board. And again, I think that's a very different type of approach than, let's say, like the observational side. And I don't necessarily think that one is better than the other. It's just, where do you feel comfortable? And I think that's something that, is undervalued when people come out of school and go to risk-taking roles, is that at the end of the day, I think you have to be able to go to sleep at night and, feel confident in whatever positions and sort of process that you have in place. So I'd say that those are kind of like the two ends of the spectrum. Personally, I honestly lean a little more to the left of that. We do have a couple of things that run a little more to the right, but again, those tend to be very hard to generalize. They look great in the back test, and especially in that macro sort of thick world, I think that's not just a pure sort of data problem. As I think equities, I would make the argument that equities is more of it tends to be tough to generalize. So in the middle there, then you have this idea of sort of factor-based risk premia, which is, I think, where we're going to spend a lot of time, and where Kranthi is gonna sort of go ahead and sort of is an expert on. But I think it marries the two, right? I mean, I think in this world, this is how a lot of institutional investors take risk. It's how a lot of pod-like portfolio managers take risk. And what it is generally, there's some sort of common theme or understanding to why a structural dislocation in the market should persist. And then there is an attempt to sort of capture it using, some quantifiable method that is transparent. And it's not to say that it can't be, some sort of machine learning algorithm or something very complex, but where I think that there is, a difference between sort of that advanced predictive side, is that this bucket tends to be focused again around a sort of a quantifiable phenomenon versus just kind of blindly trying to pass as much data as possible. And this is where, there's a lot of money that follows this. And I think it's a very good first step in terms of a career for people that are coming out of, programs such as, the Stack grad school or data science. It does marry, I think, a lot of the skill sets that you use. So we'll go into the next slide. So this was a diagram from the JP Morgan paper that we, kind of asked everyone to read. And it kind of goes through, not only how you develop or how you design a strategy, but also, how you design a portfolio of these, because, again, you don't just want one, you want to be able to do things in multiple assets. So, you have this kind of different type of, where the exposure comes from, which is beta, which tends to be long only mandates, and, exposure to asset class all the way through alpha. And then again, thinking again what we were talking about in terms of how do you diversify, right? You have the factors, which are, they're calling effectively, there's the component that is the asset class. So, thinking through the FIC world as well as equities, where in the world it is, into the regions, and then all the way in terms of what type of exposure. And so that's exactly kind of how we laid it out at the beginning, right? So I'd love to talk about this a bit more. And I know that, there's some participation points here, but Kranthi did join. I think, are you all set up? I don't know if Kranthi set. Oh yeah, he stood there. And so we are lucky enough to kind of have Kranthi. So I'll come back to this maybe once he's done, if ever anyone's still around. But let me go ahead and introduce our speaker this week. So Kranthi Gade is the head of global commodity FX structuring for the systematic strategy effort here at BofA. I've worked with him since the beginning, and he's been a mentor and really helped me grow. I think that he kind of hearing about both his personal experience as well as kind of like how he approaches designing a strategy is going to be really interesting for everyone, because he has the background, and a lot of people here is a PhD from NYU, and effectively his main role is to help effectively design strategies that some of the most sophisticated institutional investors in the world can both agree, like the performance of, but also buy the rationale behind, and then invest. And so, thinking through the alpha, I mean, the alpha portion of our book is, in the billions of dollars. And Kranthi's team has pretty much designed everything that has sold. So that I'll turn it over to Kranthi, and please feel free again to ask questions and jump in. We really want this to be kind of as much of a dialogue as possible. But so I'll turn it over to Kranthi.
Sure. Thanks, Max. I think you should mute, Max. Yeah. Okay, no, it's fine. Thanks, Max, and thanks everybody for being here and giving me the opportunity. Sorry about the name. I don't know why. It's my daughter's name, so she uses the iPad a lot more than me. So so just a little bit before we go into like the strategy, just a bit of my background. So as Max said, I did my PhD in NYU Courant Institute in computer science and applied math. So my background is in like computer science undergrad and then PhD as well. But I was always interested in math, so it's a combination of computer science and applied math, I would say. And then I did spend a bit of time in research side, so at BofA. So research as in like looking at the fundamentals of the market. And again, the whole experience has been on quantitative investment strategies. But the research is a little bit more, you go into like in depth into different markets and what are the drivers of each strategy, etc. So it's been I think definitely my research experience has been very helpful in designing the strategies, because I would like to highlight like a couple of different things to keep in mind when designing like good quantitative investment strategies. So the first one I would say is what's the economic rationale for a strategy. So there's a lot of like, I mean, a lot of people now do like black box type strategies. Let's throw in like a bunch of variables and then see what comes out of it. So there is a big danger in that there's a big danger of overfitting there. So what I strongly believe, again, like different people do different things in finance, but what I strongly believe is every strategy needs to have a strong economic rationale. So a couple of examples of what that means is, let's say in commodities, which is the focus that of my career. Like you have all these physical players in the market, like producers and consumers. So they have specific hedging requirements. So they need to hedge on a particular part of the curve. And by providing liquidity to those players is how you capture premium. Now, because usually these physical players or commercial players, they are not very price sensitive. So because what they're trying to do is offload their risk that they have. So they're giving up a little bit of upside for more predictability in their return stream, so to speak. So they are not very price sensitive. So because of that, there is some premium that can be extracted. There are some, you can call them inefficiencies or whatever, by taking on the opposite side. So another example could be like in equities, for example. A lot of people are long equities, and because they don't, and there is a feature of the market is people are very loss averse. So they tend to hedge their equity exposure with, like, let's say long puts, for example. So a lot of portfolio managers long equities, and they hedge their exposure using long puts, which pushes the premium in puts to more than what is a fair value. So by, again, short option positions, you can capture some of that premium. And there's also one variety which I've seen in fixed income, where there's a lot of certain structured products flow in the fixed income markets, and the dealers had to hedge their exposure to those structured products. So that also pushes the fair value at certain points on the curve, whether it had been in volatility markets or in delta one space, away from their fair value. So by considering those, you can do some long volatility trades, which makes sense. So I mean, these different examples show that you need to think about like why a strategy should work, because there is a very specific reason that either the producers need to hedge, or there's some requirement that people buy a lot of put options to hedge their equity exposure, or like as I mentioned, like dealers need to hedge some structured product flow, etc. So that's a very important part of like you need to understand what the economic rationale for a strategy is. So the second point is, I mean, of course, overfitting. It's a very it's, I would say, the biggest pitfall in any quantitative strategy. So and some of it is I mean, you can certainly avoid. Some of it could actually be you may not even be aware of it, like some hidden biases. But at least talking about the obvious one, which is like you need to be very cognizant of. There's actually an interesting paper that I read some years ago, which talks about how many backtests you need to run. Like whenever you present any interesting backtest, you need to show also how many backtests you have run to get there. Because the more number of backtests that you run, it's easy just by statistical fluke or whatever, it's easy to come up with something that that works. And I was actually talking to a friend of mine over the weekend who's on the buy side, and it's an interesting way that they do things there, which is, so they have a backtesting system, and it's locked, like, so no, people can't access it easily. So you need to like send an email with, okay, this is my hypothesis of why something should work, and why it's worth trying. And then you need to present your case and send an email, whatever, go through the process, and then you get access to the backtesting system. And I thought it was interesting. We don't do it here, but I thought maybe we should, because it's a good way to avoid like, just try these 10 different things and hopefully one of them works. So definitely, I think overfitting, again, we can go into many hours of discussion on this, on how to avoid overfitting, but it's definitely an important part of something very important to keep in mind when doing the strategies. And the third thing I would say is simplicity. There's definitely a move towards what, like back in the 70s, 80s, in equities, there's a lot of delta one strategies. Now it's a lot more like on option space, etc. But so there is definitely good complexity and bad complexity. So bad complexity is, you say, okay, this is my whatever. A simple example could be momentum strategy. And then you add like a bunch of parameters, and and then it gets to a point where it becomes like very overfitted, etc. What is good complexity is, let's say, something that we've done on the desk here, which is it's a simple option strategy. You would sell option and delta hedge at the close. But what we realized is delta hedging at the close has delta hedging intraday adds a certain amount of premium, because intraday to intraday the realized volatility is much lower, because a lot of people when the market goes up, they tend to hedge it at the close, and that pushes up the volatility at the close. So now that the concept is simple. Like you can say, you just, instead of hedging at the close, I'm just hedging intraday. But then to implement in practice is actually gets very tricky, because now you have to get intraday data. You have to have somebody to hedge it. So it gets complex from a trading point of view, but from a conceptual point of view, I would put that on the good complexity bucket, because you're not adding a bunch of variables. It's still the concept is simple. So I think you have to be wary of what is good complexity and what is bad complexity. At the end of the day, I think somebody told me when I started my career that whatever strategy you design, it should have an easy elevator pitch, in the sense that you should be able to explain to somebody in a couple of minutes, not like a very somebody who doesn't know anything about the market, but somebody who is like reasonably sophisticated about the markets, about the strategy in a couple of minutes. It's a good rule of thumb, because what you should definitely strive for is to understand, if a strategy works, when a strategy works, and actually more importantly, when a strategy doesn't work. Because if a strategy that you develop doesn't work, and if you don't know why it's not working, then it's a problem. So I think you need to be able to articulate, okay, these are the conditions under which the strategy works. These are the conditions that it doesn't work. These are the risks that you're taking. And you need to be able to articulate those. And so for those kind of reasons, the simpler the strategy is, the better it is. So I would say, like, at a high level, I think these are the three things that I would keep in mind. One is economic rationale, like why a strategy is supposed to work, and like what's the hypothesis and why it should work, etc. And the second thing I would say is so one is the economic rationale. Second is you need to be very wary of overfitting. And then the third thing is to keep it simple. Definitely, I think there are points where you need to add complexity, but be cognizant of what is good complexity and what is bad complexity. I think these are, like, again, there are many nuances once you go into each of them. But I would say at a high level, these are the 3 points that one needs to keep in mind. I don't know if anybody had any questions, or happy to answer.
Max, why don't you start out the questioning?
Sure. I mean, I think one, again, I mean, Kranthi is well regarded across the street as one of the industry best, and I think the point about intent is just a comment I think is super valuable. Everyone I think on the call or in the class right now is very technically proficient, very smart, and so you could pretty much be given some data set X and be told to fit in some way to Y, right? And the reality is you could probably tease out something that does decently on a risk adjusted basis. So I think where this kind of idea of like the risk premia approach is extremely helpful to people that are first starting or looking to manage their own money, is that it does force you, I think, to come in with a bit of an academic prior and that sort of rationale of why and what you're looking for, versus kind of blindly sifting through again what is an inundation of data these days. So I think that's a really valuable I guess maybe to pivot then I guess to questions. I mean, Kranthi, what a lot of the people here are not necessarily finance background, a lot of stat and sort of I think like maybe a handful of computer science. So what was, as you sort of made the transition, what do you think would have been useful to have known, I guess, when you kind of first started, you left the Quran and you came, to BofA in research. I think a lot of the students here are kind of in a similar standpoint. What is there anything that you think, you wish you would have known, or things to ask future employers, or to kind of get a sense of like if this is the right, move forward or next step, in their career?
Yeah. So for sure, I think, I mean, off late, like development skills, like software development is a valuable skill, because as I said, like, the strategies have definitely become more complex. So what used to be very simple doesn't work anymore, etc. So ability to like backtest, you don't need to be like very sophisticated programmer. If you can, be able to like manipulate a data set, write some Python code, be able to like manipulate, I think large data sets is definitely a valuable skill. And the second thing I would say is, I mean, statistics. Yeah, you guys are have more than what is needed. Just to think about like, what is the is it like consistent enough, like, do some statistical tests to be able to say, yeah, this strategy is consistent through different time periods, the t-stats and those kind of things. And then the third thing I think is, I think probably the more important is to gain experience or understanding of a particular, whatever field you're trying, be it like commodities, FX, or equities, or fixed income, is understanding like the particular like asset class. You need to be able to first develop an understanding of the asset class before doing anything in it, because one of the things that that's very important, as I said before, is you need to be able to articulate why a particular strategy should work, and for that you need like a decent understanding of the asset class. Like what is like for me when I started out, I think being in research helped a lot, because I was surrounded by people who were experts in different areas. Like again, if you go in further into commodities, you have people who focus just on oil, focused on natural gas, or focused on agriculture markets or metals. For developing strategies, maybe you don't need to like know in depth about each market as such, but what you need to know is enough about the drivers in each market to be able to understand like, okay, look, there is seasonality, natural gas, there is oil is driven by OPEC, at least so you need that balance between going too deep or not knowing enough. I think that balance is something that you can get from experience, but understanding the asset class that you're going to develop in, I think is very, very crucial. Because if you come in and then you start developing strategies and then you try to backtest, yeah, there's something that's always going to work. But if you don't know the area enough, then you're not going to be like successful long term, I would say. So that's why I believe, I think depth is important. Like when we went from commodities to, I've been doing commodities for a long time, and as Max said, like when we started doing FX like a couple of years ago, it took a bit of like learning curve to understand what the FX markets are driven by. Again, there are links between the two, but it took a bit of time to understand the nuances of the markets. So I think you need to, specialize at some point. You cannot be like the expert in all asset classes. You cannot be like, I'm an expert in like 5 different assets. It's just not going to be possible, because there are specific nuances in each asset class that you need to, like maybe you can be an expert in like 1 or 2. I think that would be the, those are the things that I would say are most important.
And I just echo that about the last portion. Even from the trading side, we have, so last week we cover, however many futures markets and however many, FX markets, but it's just not possible to be, again, that subject matter expert. And that's kind of what we talked about right in the first slide about there is a trade-off to sort of this approach versus the more traditional, fundamentally bottoms up oriented approach. Like as an example, I pay 2 people that in Chicago that effectively all they do for a living is research, the beef and pork markets, and then how that, impacts effectively cattle and hog futures trading. And that's what they do. And I think building that network especially from the risk management side of that sort of information base, is the earlier that you kind of can come to terms with the fact that you aren't going to be the person that people go to for, in-depth questions. That's going to be, super helpful, because then you're going to be able to, I think, leverage yourself also better, in the sense that, you become more broad as, you are surrounded with people that can help you, manage everything that you're trying to do. And that's something that I did not do a great job of when I started, and, you really feel it. If you are kind of going down that systematic, data-driven quant trading approach, eventually you're going to start, stepping on, unforeseen landmines in markets just because you weren't aware that there is something so structural that's going through. So that, I think it's a super valuable point to take away, both, for, your future careers, as well as in terms of like your strategy development, that, if you go down more of a structuring and sort of like a research oriented role, let's say either on the sell side or buy side, and you're developing some signal in a certain market, it's always good to see if you can find those resources, and those actual subject matter experts that can comment on, well, maybe your strategy has a very short bias in something in a particular time that maybe isn't great. So like what we were talking about at the beginning of class, a lot of commodity strategies have a short gas bias, and in the winter, like right now, or as we head into winter, that can be particularly punitive. And we showed on the chart, gas is up 100% this year. So that I think that's a really strong takeaway, and hopefully that makes sense. Yeah, Dr. Ullman, I know you said you had some questions. Did you want to ask them?
Well, let me see if the class has any more questions first. You guys have any questions? Yes.
I have one question. In terms of overfitting, you mentioned. So what kind of method you will use to avoid the overfitting?
Did you hear that question? What sort of methods do you use to avoid overfitting?
I mean, it's an interesting question, and he can talk about hours and hours about it. But one thing I would say is keep the number of parameters that you use to a minimum. Like do not add parameters unless it's absolutely required, because the moment you add a parameter to something, there's a tendency to calibrate the parameter to for the strategy to do well and then overfit. So that's one. And also I think, as I said before, you need to articulate what the hypothesis is. Like, why is this strategy expected to work? What is the either as an economic rationale, either some quirk of the market, some physical players, or is it related to like hedging of the physical players, or is it related to some behavioral aspect of the market? So what is the economic rationale that you're trying to capture? So articulating that beforehand, before you try anything, I think it's very, very important. And after you come to a stage where you come up with a back test, and then you see that you have like as few parameters as possible, then I would try to do some kind of like quantitative test to see. Again, there are many different ways of doing it, but try different quantitative tests to see if like do some out of sample testing, those kind of things to mitigate that, I would say. So those would be a couple of things, like at a high level, but there's definitely a lot of nuances in it, and as you get more experience in the area, you'll come up with your own as well.
Michael.
So I had a question. So during the portion where you're talking about avoid overfitting, you mentioned statistical flu. Could you speak to what you meant by statistical flu? That's a new term for me.
I mean, what I meant is like let's say a simple trend strategy, right? Because trend strategies are very easy to, everybody understands, like why trend, momentum, why they work, etc. But what is also challenging about trend strategies is they're also very easy to overfit. You can always come up with some kind of parameterization that gets a good back test, just because again, as you know, the time series that you see in the market is just one of like if you try to simulate the market, maybe like there are 10,000 ways the market would have gone, but this is the one way that the market went. So now, yeah, you can always come up with some parameter combinations that fits this one series that the market realized. But then, yeah, then that's just because it's you took the one path that the market, you tried to fit it to the one path the market took, because, and it may be like statistically very unlikely, and going forward maybe it's not the path the market would take. So you're trying to fit to like one path the market took. So that's what I meant by when I said statistical fluke. So you need to have like a good rationale for why it would work going forward. I think that's also the point that I mentioned earlier on, not just like a good backtest, but like why it should, an argument for why it should work going forward.
Okay. I think I thought you said statistical flu instead of fluke. Okay, that makes sense.
No, so fluke, I meant like, just based on statistics, if you have like 5 different parameters, you can always calibrate them to fit to that, like an unlikely kind of set of parameters out there.
Dr. Gade, when you said, how do you determine when a strategy is not working?
It's an interesting question, and it could be due to a combination of factors. Sometimes it could just be that a strategy is designed. It's like, again, going back to a trend strategy. It could just be that that the strategy is designed very well, but the market is not. The market environment is not the right environment for that strategy. So, for example, like a trend strategy that we have, like which was live since 2015-16. So that had like a couple of down years, but then this year it has performed phenomenally well. And yeah, and it hasn't performed in the last couple of years because there was just no trend in the market to take advantage of. But this year there was a strong trend and the strategy took advantage of it. So in that, it's I would say it's more an art than science when you like when you say a strategy is not working. It's a bit hard to tease out whether it's the market environment that is not right, or whether the strategy is not designed very well. And sometimes it could be the strategy, like the parameter choices that you made may turn out to be not ideal going forward. Like, for example, in a strategy that we looked at, we look at like last 1 year time frame, and it's kind of like a momentum kind of strategy. And it turned out that when you have like very sharp moves in the short term, then that 1 year time frame may not have been the ideal choice, for example. And you have to be like very honest about it, like look, this is the strategy, it may not be well designed, and then go back to the drawing board. But sometimes it could be just the market environment that's not working well for a particular strategy, and you just need, that's why for the trend strategy that I mentioned, we stuck with it. Like, we did not come up with a new strategy because we knew that the market environment is not really conducive, and this is still the best trend strategy that we have, for example. So yeah, to answer your question, I mean, it really depends on strategy to strategy, and it's more an art than science, I would say. But it's also something that you learn with experience.
Max, why don't you close us out? Thank you, Dr. Gabi.
Sure. Thanks, Kranthi. Yeah, I mean, so I guess, I know class ends at 11:50. I'm happy to stick around as is needed. And we can chat more and keep going, but let me just quickly go back to what we were looking at. So let's see. I'll just do it here. So just to go over next time, it will be, I think as of now, Dr. Coleman, correct me if I'm wrong, Wednesday, October 13th. This time in theory is the time that it will be in person. So we're gonna pivot a bit. I mean, I think we'll still try and keep the vein of, how does everything sort of fit into, again, like this quantitative finance, systematic trading framework, but we're going to sort of pivot a bit and focus a bit on one asset class in particular outside of equities, and so that is commodities. Like I mentioned last week, I mean, I think the futures market, and especially the commodities market, is probably the least sophisticated. And I think honestly, if I'm looking to start a career now, I think the steps are, where has the most room for upside growth and sort of innovation and development. And, like we said, honestly, equities is pretty picked over, and it's very efficient. FX is also very efficient. The commodities markets are interesting because they can continue to list new underliers that represent completely different markets at a much faster pace, I think, than, let's say, equities. And so I don't know if I mentioned last week, but one of the big things that sort of got listed this year, one is power. Obviously, again, given some of the ERCOT moves and, people who didn't even know what an ISO was now all of a sudden are experts, but as well as water futures, and sort of like the water as an asset class is becoming more in vogue. So I think it's a really interesting space. We're going to have someone who's going to come. He's not going to be honest, not the most quantitative person, but I think that's okay in some senses. Again, you have to, going back to like the idea about having resources around you. I mean, I think orthogonal thought processes and sort of backgrounds is also is very valuable, because it's very easy to get trapped in sort of a confirmation bias of like-minded thinking from the people around you. So William Brandifin has been a broker. He's a good friend. He's been a broker in the markets for the last 25 years in commodity futures. And so he's seen, where things traded by hand signs on the pit in the 90s all the way up to now, where honestly there's quite a bit of electronic sort of innovation in execution. So that'll be next week. I don't exactly know how the sort of homework and assignment things works, but if any guys have time, I would love, I did find couldn't get approval from BofA, but Citi, which is probably third or fourth kind of like listed in terms of like what we do, ranked on the street. A lot of their strategy descriptions are actually floating around online. And so I posted the CVI COT S1 strategy description. So if you think about what we talked about last week and how, again, everything is rules-based, it's supposed to be transparent. It is actually replicatable. I mean, if we, depending on how things go through the semester, we can actually maybe organize some of the data set for you. We can actually work on improving the strategy. But to start, the actual description is listed. And
it's in the document 2.2 Civicots on our readings site.
Exactly. So it should be there. It may not make a ton of sense in terms of like, what the payoff is. But I don't think that part is that necessary at the moment. What I'd love is if, you spend a couple minutes and sort of read through how they wrote it and what they're trying to capture and, the parameter set that they used. And I'd love for you to kind of like critique it a bit. Because honestly, it's very hard to sit someone down, especially if they're brand new, and say, make me a strategy, or, come up with an idea, come up with a trading methodology that just generates dollars out of thin air. And so a lot of what people do when they first start, both in the structuring, trading, buy side research, a lot of it is sort of, improvements on existing frameworks and existing signals. So, this strategy, it's a fairly simple one. And again, going through that trade-off between parsimony and return is important. So it's fairly simple. And I'm going to try and grab the actual performance of it from Bloomberg, and we'll see if we can send it around. But, think about what would you like to do differently, as you guys are, budding portfolio managers, and if it's your own money, for example, what would you think could have done better, and, why do you think that that's the case? You know, how would you show robustness? I mean, any sort of, I think those thoughts, and just sort of see like, how do you analyze someone else's sort of systematic strategy? And this, I actually know that this is sold. I don't know if it's still on. That'd be a bit of a dinger. But I do know that this actually did sell once a couple of years ago to some people, to some clients. So, you know, to some extent, you know, there is, in theory, some sophisticated money that allocated millions of dollars to it. So it'd be interesting to see what you guys kind of come up with, and what you think can be done differently. So I also don't know, you know, exactly how that gets submitted. If you want to send it to me, fine. I'd love to chat with everyone individually, and we'll try and give feedback and comments and questions. But you know, Dr. Doblin may have a better method. But so that's it. That is where we'll be come mid-October. Are there any questions, any thoughts? You know, like I said, I can stick around as long as someone wants to stick around. So by all means.
Why don't we, if you want to discuss this strategy, to create a discussion on Canvas, and that way everyone can participate in the discussion.